Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you're keeping incredibly well. And I hope you have some lovely plans lined up for this wonderful long weekend we have ahead of us. I think the weather is actually predicted to be quite nice again, which, I can't quite believe it at the moment. It's wonderful, isn't it? So look, what do we have for you this week on MFB News? We're going to do our usual update on the lender space. There's been some fairly large news in regards to an existing lender stepping away from the market. So we're going to talk a bit about that and the impact it's having on people who have applications in with them at the moment. I'm going to let you know some changes from one of the largest buy-to-let lenders in the UK in terms of criteria. Then I'm going to go through what's been happening on interest rates. We're then going to talk about the latest nationwide house price index that's been released and talk to you a bit about the key findings in there. And then lastly, I'm going to be discussing with you a report that I read, which was produced by some economists in terms of their predictions on interest rates, not just to the end of 2022, but actually extending into 2023 as well. Okay, so Molo have announced that they are stepping away from the buy-to-let market temporarily because they've got some issues with their funding line. So what this means is that Molo are not actually lending you their own money when they offer you a mortgage, they're lending you someone else's money, which is very, very normal in the kind of specialist end of the market. So not all lenders do this, but there are plenty that do, so they rely on funding lines from institutional funds. So what's happened is Molo appear to have run out of money, which means that they are now stopping any new applications going forward until they can sort their funding line out. Unfortunately, what it also means is that anyone who has an application in process with them, they will not be able to proceed that any further. And those people who have mortgage offers in place already from Molo, they're not going to be able to necessarily complete on their mortgages. So what we've been advised by Molo, and this news is fairly new and we haven't had anything 100% sort of confirmed at this stage, but our understanding is as follows. If you have an application in with Molo that has not offered, but you have spent fees, valuation fees, they will be looking to refund you those. If you have a mortgage that's gone to offer, they are hoping to try and make good on as many of these offers as they possibly can, but it's not guaranteed. They're going to be writing to all of their applicants, whether your application is offer stage or pre-offer stage, writing to you or your broker directly and letting you know what's going on and what the next steps are. Now, if you have been affected by this, and we've had some of our clients have cases in pipeline with Molo, do get in touch with us. There are other lenders who offer a very, very similar lending policy to Molo. So as much as the timing of this is incredibly bad and some people will be a fairly long way down a process, that it's going to leave them in probably a very difficult position, actually there are going to be other lenders who can step in and pick the case up. So do give us a call if you have found yourself in that situation. Now, in terms of the brokerage and how we feel about this, so obviously this is really poor form. It's very, very bad practice. I don't know the ins and outs of what's happened with Molo, so it wouldn't be fair for me to sort of sit here and criticise them. But what I do know is that from a broker's perspective, it leaves us in a very difficult position, but more importantly, it leaves our clients in a really bad situation as well. So obviously very, very disappointing news. This sort of thing doesn't happen often in the mortgage industry. This isn't a kind of commonplace occurrence. And it's not that we're expecting lots of other lenders to follow suit, because that would be another concern for people. Well, if Molo have done this, are other lenders also going to be finding themselves without any funding, even temporarily, and is my application at risk? So like I say, we have seen this happen in the past. It's not a common occurrence. We've got no other kind of reports of any other lenders having a similar problem. So we're hoping that this really will be just isolated to Molo and we won't experience any other problems for any other lenders at the moment. Our understanding is that from the institutional funders in the city, they have a huge amount of appetite to lend on buy-to-let transactions. There's no reason why we would see a repeat of this. Now, the other kind of a bit of big news, I suppose, is that the Mortgage Works have made a fairly significant amendment to their lending policy. Now, the Mortgage Works are one of the largest buy-to-let lenders in the UK. They're part of the Nationwide Group. They are fairly steadfast in their criteria, so they don't tend to change things very often. But the thing that they have changed is their maximum loan to value on new build flats. So previously what they were saying is that if you want to purchase a new build flat, their maximum LTV would be 65%, and they've now increased this to 75% loan to value, which is really, really good actually, because for some people, where particularly when people are buying buy-to-let properties, most people tend to borrow at 75 rather than 65%. Now, in terms of where this sits in the market, so actually there are a surprising number of lenders who still dislike new build flats, and this is really an overhang from the credit crisis. There are many other lenders who will lend 75% on new build flats. So it's not that there's kind of, this is a standard position by lenders. But actually you'd be surprised how many lenders either won't, restrict their loan to values or actually won't lend on new build flats at all. So it's really, really encouraging to see the Mortgage Works makes this change. Now, when a lender as large as the mortgage works makes such a sizable change to their criteria, you can guarantee other lenders are going to be looking at their policy and saying, well, hang on a minute, where do we sit on this? Can we amend our kind of appetite to kind of keep aligned with the market? So you may see more lenders following suit to sort of really make sure that they're remaining competitive in the marketplace. Now, in terms of pricing this week, I'm not going to award anybody for guessing, because it's fairly obvious that the rates have been going up. I read a report the other day that there's 145% likelihood of base rate going up next week. So needless to say, the lenders are putting their rates up left, right and centre. So who's moved this week? So the mortgage lender have pushed their rates up. LendInvest have released new green products, which are more expensive than they were previously. Vida Home Loans have removed the majority of their 60 and 70% loan-to-value products, and those that have left have increased by 0.6%. I mean, that's a sizable increase at the moment, right? So that's fairly chunky. So they must have been lending at a fairly a very low margin or even a loss previously to need to put it up by 0.6%. Santander have increased their rates by 40 basis points. I think that's as much to do with business volumes as anything else. So Santander, when we looked at the rates, this would be in the personal end of the market, their rates were actually very, very competitive. They were coming up kind of top or very near the top in terms of pricing. And I also know that Santander have been really struggling on service. So I think what's happened here is Santander have made a fairly large increase of 40 basis points. The cost of 5-year fixed rates haven't gone up by 40 basis points, right? So they've done this, I think, as a kind of step to slow down business volumes, stop attracting so much business so they can get on top of their business levels. Now, we've also seen Skipton increase some of their 5-year fixed rates, and interestingly, they've reduced the early repayment charges. So on 5-year fixed rates, the early repayment charges tend to be 4%, 332, or 332, or something along those lines. For some reason, Skipton have decided that they don't feel that their early repayment charges were kind of attractive, or maybe just weren't balanced by the interest rates they were now increasing things to, so they've reduced those down. Now, we've also seen Metro Bank make some changes to their products. So they have removed their 70% loan-to-value products. They have increased their 75% loan-to-value rates, and they have reviewed their 5-year fixed rate stress test and increased this to become 140% coverage, assuming a notional rate of 5.5%. And the reason they have done this is that they were stressing on a lower interest rate before, so it would be 140%, say 5%, but obviously interest rates and base rate has increased, so they've simply amended the notional rate they're kind of stressing on to reflect this. We have seen a couple of other lenders doing this over the recent weeks, which just means that essentially if you're looking for a mortgage, you can borrow less per pound of rental income that you're receiving than you would have been able to do previously. Now, when I say other people are doing this, there are lenders that are making these changes, but likewise there are lots who aren't as well. So at the moment, so if you are thinking about remortgaging and the numbers are a bit kind of skinny, don't panic, give us a call. I'm sure we'll be able to find something for you still nonetheless. Now, lastly, I mentioned, I think it was last week, possibly the week before, that HSBC had interestingly repriced downwards. So everyone else is pricing up, HSBC came down. And I was saying at the time that I feel that probably what they had done is just overpriced to kind of slow down business volumes, in the same way that we mentioned that Santander have increased their fixed rates so aggressively. So what HSBC did was they put their pricing down, and guess what, guys? They've gone up again. So HSBC have made a pricing increment to their rates this week. And that is the lender pricing changes and criteria changes that we've seen in the last 7 days. Okay, now Nationwide have released their latest house price index, and there are some little nuggets in there that I wanted to share with you that I found really, really interesting. So first of all, the headline is that annual house price growth has increased to 14.3%, and that's up from 12.6% in February. The strongest performing region remains Wales, whereas London remained the weakest. Now, it's not that London hasn't grown at all, it's just seen the slowest amount of growth compared to other regions. So the typical price of a UK home has climbed to a new record high of £265,312, with prices increasing by over £33,000 in the past year. Prices are now 21% higher than before the pandemic struck in early 2020. Now, what they went on to do is talk about the shift in kind of housing preferences over the pandemic, and how that's kind of, I guess, set a big kind of gap between how certain property types have performed. So what they're saying here is that between Q1 2020 and Q1 2022, the average price for detached property increased by 22.6%, which is nearly £68,000 in cash terms. Meanwhile, over the same period, flats only increased by 14.1%, which is around £24,000 in cash terms. So what they're saying is that actually, consequently, it's becoming increasingly harder for property owners to upsize in terms of the properties that they own, because if you're selling a flat at X value, but the house that you want to buy has increased by value, not in proportion, but actually, you know, far greater percentage, it almost prices you out of that market. So now we're seeing a blocker, not just with first-time buyers, but also with home movers as well. Now, I was reflecting on this and thinking, actually, as a landlord, where is this useful to us? Where's the opportunity? What can we do with this information? And I think, you know, it'd be fair to say that actually, if you are looking for a relatively safe investment, something that's going to perform really well, and actually there's been an increase in demand for houses in terms of rental as well as purchasing, I think actually it's fair to say that right now your safest bet is going to be houses. Having said that, you know, people are very happy to live in flats, and once the pandemic becomes more of a distant memory, I think more people will be prepared to sort of see a return to living in those kind of more built environments. So actually, it could be that if you were thinking about investing in a flat at the moment, you may see the potential for a higher upswing in terms of property value growth over the coming years. So there could be a good opportunity for you there as well. And that's everything for me this week. Sorry, I had a really late night last night. We were out as a business at an awards do. I didn't get to bed till 1 o'clock in the morning. So apologies if I'm not entirely sharp today, but hopefully there was enough information there which you found useful nonetheless. But if you do want to give us a call to chat things through, if you call today, hopefully you'll get through to someone who's had a bit more sleep than I have. The number's 0345 345 6788. Or have a look at our website. These guys never get tired, mortgagesforbusiness.co.uk. Have an incredible bank holiday weekend. I hope the sun shines down on all of us, and I will see you again same time next week.